Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Peter Oppenheimer of Goldman Sachs writing, it's possible that tariffs could hurt equity prices even if the US agrees on deals with key trading partners. Peter joins us now for more. Peter, welcome to the programme, sir. Before we talk about the risk, let's talk about the price. The rally we've seen on both sides of the Atlantic on the S&P and the Euro Stoxx 50 of close to something like 9%. Peter, when you break things down, let's just talk about breadth. Compare and contrast the story in the United States to the story you're witnessing in Europe.
Well, very different story. At one level, it looks very similar. As you said, both markets are rising, but they're rising in different ways. The contributions are quite different. In the US, very much driven, again, by the power of the biggest tech stocks, which are really leading the market. As you say, S&P is at an all-time high. The median stock is around 12% below its 52-week high. So very, very concentrated. Whereas in Europe, actually, there's significant breadth. Unusual breadth, actually, in the market, and you're seeing much less concentration, although, of course, you are seeing and have seen stocks that are disappointing being very heavily punished, and that's happened on both sides of the Atlantic.
So, Peter, let's just pick up on the US tech story and the narrow breadth that I've heard so much about, and I'm sure you have as well. Whether it is necessarily unhealthy, if I think about the dominant risks at the moment, they're largely cyclical, they're related to trade, and in many ways, some people might look at the US stock market and say that's a source of stability, not necessarily downside risk. Pete, how would you counter that?
Look, I think it's right that, if we step back and think about economies which are still growing, albeit at a slower pace, certainly in the US, but interest rates coming down, that's broadly a supportive environment for risk assets. And the fact that in the US, the tech heavy largest companies have been dominating the rally is a function of their very, very powerful continued profit growth. It's not been about speculation. It's really been about very, very strong fundamentals. And there's nothing wrong with that. The only problem, of course, is that as you get an increasingly concentrated market, it becomes harder to diversify risks, at least domestically. And that's one of the reasons why we've been arguing that investors should take a more open mind view of diversification geographically to improve risk-adjusted returns.
Well, Peter, where is the opportunities in Europe? Because I'm looking at the Bank of America Fund Manager survey out of Europe, and they say European investors, 35% expect stronger European growth over the coming 12 months, but it was 44% last month. So isn't that European story actually starting to dwindle a little bit?
Yeah, and we've seen that to some extent in the relative performance. Very much the first part of the year, Europe outperforming both in terms of underlying assets, but also on a dollar-adjusted basis as the dollar weakened. And that difference has moderated to some extent. But I think it is right to say that from a very low base, European growth is improving somewhat. And an important driver of that is the expansion of fiscal policy coming from Germany. And we do also have a couple of other themes that are encouraging interest, particularly increased defence spending, which is powering ahead, more infrastructure spending across Europe, and also some of the value areas of the market which are doing really very well, banks being a perfect example. And I would say that is another difference between Europe and the US. The US is still being driven by growth-dominated themes, particularly related to technology, whereas in Europe and some other markets, value is actually outperforming.
The risk of tariffs, though, still exists, and the team at Goldman Sachs had a note out about how the impact has yet to hit. Consumer prices, when it comes to tariffs, that hit is just getting started. What could this mean for Europe and some European corporate names?
Well, I think that it does complicate the picture because we haven't yet seen the full effect of tariffs on either side of the Atlantic, and it is likely to weigh on consumer confidence to some extent and the ability for consumers to continue to drive economic growth. And we're already seeing some evidence of that slowing, particularly in the US, and alongside it, some weakness in the labour market. The offset, I think, is that you will see lower rates, at least in the US. We think for the ECB, they're done for now. They've already cut rates more aggressively. And I think there's less room for that to continue, given that we're going to see some effect of tariffs still yet to come through.
Peter, you mentioned the rally we've seen in US tech, validated by the earnings. The earnings have been really powerful. I believe you said the same thing. For the banks and the run-up we've seen in Europe, this rally of more than 40% for European banks so far year to date, has it been justified also by the earnings you've seen so far and the outlook coming from the C-suite?
Yeah, very much so. And we have to emphasize that this is a huge turnaround from the trend that we saw really for a decade after the financial crisis, where banks came under huge pressure, particularly in Europe. They had to delever, raise capital, cut dividends, and although they were cheap in terms of multiple, they kept on underperforming. But we've seen a dramatic change in circumstances. Now they have strong balance sheets. You mentioned earlier that the credit cycle is benign. And more confidence in the economy means less risk of loan losses and credit losses and provisionings for the banks. And we have steeper yield curves, which are very supportive of their profits. So in Europe, the very powerful returns that we've been seeing in banks is justified by very strong fundamentals, just as the technology companies have been supported by fundamentals in the US.
Can we just touch on the rates backdrop for Europe? For a long, long time, they complained about negative interest rates. We got away from that. Now it feels like rates are starting to come back down again, Peter, and maybe they don't stop at 2. Perhaps they don't stop at 1. How important is the rate outlook for the long story on banks?
I think the most critical factor is going to be growth. If we avoid recession, that would be our central view, then the risk of a provisioning cycle that could be damaging for earnings is moderated. Of course, what's been very helpful for the banks, and this has been true in many regions, particularly in Europe, is that yield curves have steepened. We've seen already a lot of progress on short rate cutting by the ECB. But long rates have been edging up, partly driven by growing deficits and spending, particularly in Germany. And that spread has been very helpful for banks. It may moderate a little bit moving forwards, but I think if we continue to get economic growth, the outlook is still reasonably benign for the banking sector in Europe.
Peter Oppenheimer of Goldman Sachs. Peter, appreciate your time. Joining us now, the former Boston Fed President, Eric Rosengren. Eric, welcome back to the programme, sir. Some healthy debate at the Federal Reserve. Let's call it what it is. It is healthy. Do you think September is too early to settle the debate?
I think it depends on how the data comes in. We have 2 CPI reports, 1 PCE report, and 1 employment report. The data can be pretty noisy, so I think we need to see what things look like as we get into September. But I agree that if the CPI and PCE are reasonably well restrained and the labor market looks weak, then it would be appropriate to ease rates. However, it's also quite possible that we'll see a slowly increasing inflation rate. I'm expecting the CPI will probably be, the core CPI will be above 3% when it comes out tomorrow. And if we start seeing numbers that look higher than the market's expecting, sentiment can change pretty quickly. So I think it's a little too soon to call September. I think the Fed was acting appropriately when it wanted to wait and see, because right now, while the payroll employment was weak, the unemployment rate was 4.2%. And the labor market has had a labor supply shock. So you probably want to focus a little bit more on the unemployment rate than the payroll employment numbers.
Eric, as you look at the dual mandate at the moment, and this really speaks to the divide of the Federal Reserve, there are some individuals who want to focus on the employment side of the mandate, others who still want to focus on the price stability side of the mandate. Can you share with us your experience? Did you prioritize one side over the other? Are they created equally?
So everybody can vote and weigh. I mean, you're not given the weighting function. So each person can kind of choose for themselves what they think is most important at the time. But the framework document actually talks about what you should do when both elements of the mandate are not where you want it. And in that document, it argues that you should look at how far away you are from where you want to be and how long it'll take to get there. So on inflation, if you look at the core PCE, we're at 2.8%, and most people think it's going to take quite some time for us to get back to 2%. If you look at the unemployment rate, we're right at 4.2%. So despite the weak labor supply that's been happening, the labor market doesn't look to be in that much trouble. You don't see initial claims rising rapidly. So while I know a number of participants at the FOMC are talking about concern about the employment mandate, it actually is exactly where they forecast they want it to be, which is at full employment.
Basically, what you outlined there says that the Fed shouldn't be cutting just yet. So is there a bias to a weakening labor market?
So it depends on a forecast. And I would say private sector economists do not see a rapidly rising unemployment rate and do not see an elevated risk of seeing a recession. So I would think the rhetoric around the labor market would be more consistent if the private sector was seeing more evidence in the data that the unemployment rate looked like it was going to rise, that initial claims was going to rise. So I think at this time, it's a little bit odd to overweight the employment part of the dual mandate.
Eric, can we just sit on the data? And I want to avoid the politics. Don't worry about that. Not going to include you in any of that whatsoever. We're always dependent on the data, and there's been a question for a long, long time about how dependable the data actually is, particularly the labour market data prone to very large revisions. We saw that last year. We've seen it many times in the past as well. Eric, how did you manage that situation? Were you less sensitive to incoming monthly reads, knowing that at some point in the future they would be revised? How did you approach it?
So if you focus on a forecast, month to month doesn't matter nearly as much as where you expect things to go over time. And as you point out, the labor market data, particularly the payroll numbers, can be pretty jumpy. And the reason for that is not because anybody's manipulating it. It's because they do a survey, and if people don't fill out their survey forms on time, then in the revision, they pick up the additional surveys. And so depending on what the response rate is, and the response rate has been going down on many U.S. government surveys, it becomes less accurate, and the revisions can be larger as they get additional data. So you never should put too much weight on any one data point. You're really looking for a trend. You're not actually looking for, while Wall Street focuses on beating expectations and having a number, comparing the current number to what they expected, central bankers should really be worried more about long-term trends. So long-term trends don't get affected as much by a single data point. So you should smooth through most of that data, and that's what most forecasts end up doing.
Eric, do you think there's concern, though, that now the U.S. data is no longer considered the gold standard, given the fact that the president ousted the commissioner of the BLS?
Well, it depends on who replaces at the BLS, but it would be very disturbing if you didn't have reliance on the data. And the U.S., not just the BLS data, but the GDP data, the inflation data, all that data is critical to making good policy choices. And if that data is manipulated in some way so that you can't rely on it, it becomes very problematic for policy. And while the initial changes are probably not going to be that noticeable, over time, it can create havoc. And I think you see examples of that. And the Wall Street Journal did an article on what happened in Argentina when they started manipulating the data. China has been famous for dropping series that didn't work in the way they were hoping. So, for example, youth unemployment is not reported anymore on a consistent basis. But you see young people coming to the United States because they can't get jobs in China. So you can conceal to some extent data, and for month to month you can get slightly better numbers, but over time, if you're manipulating the data, it becomes obvious to the public.
Eric, the president's nomination to fill Governor Kugler's seat, Stephen Myron, is an individual that is already working with him as one of his economists, the head of the CEA. Less than a year ago, Myron was against cuts at the Fed. Does he look purely political now, potentially, to his new colleagues at the FOMC?
I think there is a consistency problem. He has traditionally been somebody very concerned about the inflation part of the mandate. And so his newfound interest in the labor market and the need to lower interest rates looks somewhat out of character from what he was concerned about over time. He's written about being concerned that there's too much politics at the Fed. He obviously has been a strong proponent of this administration's policies and seems to be a proponent of lowering interest rates, which has been advocated by the administration. So if what you're looking for is an independent Fed, he probably is not the perfect choice to ratify an independent Fed.
Eric, appreciate your opinion. Thank you, sir. The former Boston Fed president there, Eric Rosengren. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, can you think of another example of something like this playing out in your lifetime?
Certainly not at BIS. Wendy points it out exactly. There's not another example like this. I think the most interesting way to look at this is to see the president sort of expanding out beyond something that was a very real concern for him on Friday. If you followed his Truth Social post, it was very much about these court cases that are pending around the IEEPA tariffs. So if the president is going to be stripped of his authority to impose tariffs via IEEPA, is he giving himself some sort of additional leverage point with export controls and selling them to effectively the basic way of just getting trade flowing and having some sort of card to play with China? I think that's an interesting angle to think about. I think the IEEPA court case story is the most critical here, and the president obviously was focused on that on Friday, and then this announcement makes sense in that context.
Henrietta, if you're in a C-suite of a massive American company and you see what's playing out right now with NVIDIA and AMD, is this a new risk that you need to contend with, that potentially if you want to export your products to outside the United States, you might have to pay the U.S. government?
I think it completely stands to reason. And every single one of these trade deals has some sort of payment component. And what happens is we get these original announcements and then they get materially walked back. So this one's pretty cut and dry, 15% in the event that that's where it lands. But think about the Japan deal, for example. The White House said that's $550 billion worth of investment that's going to flow to the United States, and we get 90% of the returns. But the reality is that only $11 billion of that $500 billion that Japan committed to is going to come from the Japan bank. Everything else is going to come from private sector that you have no control over. So there are these big numbers floated, and then they're almost always revised. Another example, to give you another one, John, would be the gold tariffs that are happening right now. This, sort of rampant confusion before there's an ultimate clarity is really the prevailing theme of this administration.
Okay, but when you're talking about pay components when it comes to other trade negotiators, it's about investing in the United States, because that means money and jobs for Americans coming into the United States. This is purely about just paying some of your profit streams for chips that at one point you were already sending to China to the U.S. government. How is this in line with what the Trump administration and the campaign ran on?
Well, it's definitely not consistent at all. Either there was a national security threat exposed to these chip sales, which is something that we've been dealing with for at least a decade, or you can just pay your way around it and it's no longer a national security threat. They are two mutually exclusive developments. And I think, again, it goes back to the president needing more chips in the China negotiations because, for example, the export of U.S. soy and agriculture goods is down 50% in just the last 6 months, dropped from like $11.5 billion worth of sales to $5.5. The president needs more ammunition. And if he can somehow create a reliance, which is what we've heard from the NVIDIA CEO, on U.S. chip sales, then that gives some additional leverage perhaps down the line. But it's definitely mutually exclusive to the national security argument.
How much leverage do they have right now, Henrietta? I think that's worth exploring. If you look at the Chinese export numbers, they seem to be doing okay. The export numbers are up. The exports are just going to other places. Is this important to them in the same way it was maybe 6 months ago, maybe several years ago, 4 or 5 years ago?
Yeah, absolutely. And this is what you always have heard from China very consistently. The United States is a bully. Come do business with us. We're seeing it operate in Africa right now, and the EU and other nations in the Southeast Asian region. And one of the things to be mindful of as we get into this is that the president has threatened 145% tariffs. 80% would be the rate that goes into effect on August 12th if they don't reach a détente. But China plainly has the president in a corner around magnets and rare earths that debilitate the automobile and defense sectors in one fell swoop. So the reason that the 90-day pause is the base case on the street is because the president threatened too much, and he's not going to get it. We don't have the capacity for that. Goldman's coming out with 67% inflation hike to the U.S. consumer and prices being passed on. We do not have that ability right now. It's the same reason, not to go to too many places, but it's the same reason you're not seeing the Russia sanctions go into effect. You cannot mess with oil and gas prices when we have this risk of inflation coming.
What would be helpful is if the Europeans and other trade partners got on side with the United States to put the pressure on China, to put the pressure on other trade partners. Henrietta, do you see those pieces coming together anytime soon?
I don't. And think about what we have pending. You got Section 232 pharmaceutical tariffs, automobiles, automobile parts, semiconductor chips, all those outstanding components. And the EU is not at all thrilled with the deal that was reached a couple weeks back with the United States. So that block is fractured to the point where we don't even have legally binding text, and we might not for months now. So I don't see that coming around. We don't have Canada even, so I think we're quite a ways away.
What kind of weight does the U.S. have when it goes to Brussels and say, really put the screws to China, given the fact that now the United States is saying, well, actually, we'll send some chips that we thought were national security concern, but you just have to give us some of the profit?
This is really the underlining issue that all of our trading partners has had. Who is the ultimate decider? Where is the line in the sand? What are we even negotiating? And that's been a consistent theme that we've seen from Japan and Korea and the EU is what is it that we can offer? What can we commit to and write into legally binding text on our end that we can then go and operate with around the world? And that's not something that they have any ability to even get in the room in a timely manner to have that conversation. And there are so many outstanding issues. And I would just say one more time here, the market is the inflation is not a one and done situation. We're still going to get lumber tariffs on Canada on top of the ones that the president put into effect on Friday. We still have outstanding sectoral tariff risks with all of these major trading partners from Switzerland to Ireland. There's no certainty here, and I don't have any reason to think that would end in the next 3 years.
Just briefly, how much money is coming in the meantime, Henrietta? Just how much are we taking in month on month at the moment?
I think last I saw was $27 billion a month. So ultimately, this is a $2.7 trillion revenue raiser that the United States consumer pays for. And the inflation numbers are going to get compounded because, again, this is not a one and done event. Tariffs have increased at least a dozen times just in the last 6 months. And there are at 9 on the horizon just in the sectoral tariffs, without even getting into 301s on Brazil or the IEEPA tariffs and whether or not those can be maintained. And then we're going to throw export control restrictions on top. There's a long way to go.
Henrietta Treyz of Veda Partners. Henrietta, thank you. I'm pleased to say the man himself joins us now for more. Ryan, welcome to the programme, sir. Just describe, if you can, the activity that you've seen over the past few months, the rush to secure air freight, all kinds of things, Ryan. What are you seeing?
Yeah, hi, thanks for having me on. Wow, it's been crazy volatile ever since the Liberation Day tariffs were announced. Immediately after that, you had a 60% decline in ocean freight bookings from China to the U.S. That lasted about 5 weeks, so just a massive decline of freight coming out of China. You then had, once the tariffs were relaxed, a surge to 80% above the pre-tariff level of volumes. That's what I was describing in that tweet. And now I think that was from a couple of weeks ago, because things have been settling in, and now we're seeing the real effect of tariffs, which is people shipping less stuff. Prices of ocean freight are coming way down, back to, we're probably over the next few weeks going to see prices back to levels that we haven't seen since after the pandemic in like 2023, when prices were quite low. So I don't know if you call that normalizing or just like doing what you would predict, which is tariffs should lead to less freight, which should lead to lower prices. And it's not great for companies involved in the business.
Geographically, Ryan, what ports are dealing with really soft demand?
I assume that it's pretty evenly distributed across all the ports. I don't think there's a trend by port. It's actually one thing that has happened here is the airports, because when the tariffs are announced with such short deadlines, you see this huge rush to ship air freight in. And that sort of ended a couple of days ago at the end of last week when the new tariffs took effect. But in the prior 2 or 3 weeks to that, there was this huge switch from ocean freight to air freight. So I met one customer who said they saved $2 million by switching 4 containers from ocean freight to air freight just by beating the tariffs.
We've seen this administration really try to go after transshipment. How is that affecting the supply chains and what you're tracking?
Yeah, this new transshipment rule is quite interesting. So basically what they've said is that if you have one duty rate, which is around 20%, for goods from, for example, Vietnam. But if the goods are determined to be transshipped from another country through Vietnam, then the duty rate is much higher. This is a very strange policy because historically, in all precedent of country of origin rules, then Vietnam has nothing to do with the duty rate. If they're transshipped through Vietnam, the duty rate is still China. China's duty rate is not Vietnam. So it's quite a confusing rule from those in the industry. What we're basically saying is, hey, in addition to going to jail for committing customs fraud, you're also going to have to pay a higher duty rate. So, I mean, I guess it's effective, but it's very strange policy.
But have you actually seen it work when you're tracking all of this cargo?
No, it's not. I mean, because it's a sort of a nonsense. It's basically saying, hey, if you're committing fraud, then you have to pay a higher duty rate. Well, the penalties were already much worse for committing fraud than a higher duty rate. So no, we haven't seen anything change because of it.
Ryan, how creative are people getting? What kind of mitigation strategies are they introducing? What are you suggesting? What are you advocating for?
Yeah, I mean, the first thing I'm advocating is don't do anything illegal, and there's a lot of incentive to break the rules now because and you do see people who are breaking the rules now. For example, if you import goods from China and the Chinese company serves as the importer, and all you do is the American company that used to import them, and now you're just saying, hey, I buy them in America. The Chinese company imported them, and they happen to cheat on the customs duties. That's not my fault. Well, guess what? Customs will hold you liable. That's not a loophole that you can get out of so easily as that. What's legal and what we're advising people to do is look very closely at 3 things. 1 is the valuation of the goods. 2 is the country of origin. And 3 is the classification. Now, all of these seem like black and white, but they're not. This is the law. This is regulation. And therefore, there's a lot of room for expertise to come in and identify what is the gray area and what is the legal gray area. How do you stay on the right side of that legal area? And some of it's not gray. It's just sophisticated. So on valuation, if you provided CapEx assistance to your factory, or there's other rules that you can say how that lower the value of the goods, you would pay less tariff. You got to do it legally, though. Make sure you have an expert. On the country of origin, similar things. How do you classify this? How do you qualify this as being a country of origin that has a lower duty rate? There's a lot of sophistication in that as well, of saying, hey, did you apply enough new value added, either materials or labor in that other country to change the country of origin legally, not committing fraud? And the third is classification. It's illegal to change the classification of your goods in order to achieve a lower duty rate. But if the correct classification of your goods happens to have a lower duty rate, you win. So there's, again, a lot of work that needs to be done by sophisticated people who understand these rules that can help you out. Flexport has a team that does this, as do many other companies.
Ron, are you finding that more work just means more time? Is this slowing things down?
Yeah, it's definitely increasing costs for everybody in myriad ways. I mean, even just if you want to bring goods to another country, transform them, change their country of origin, and lower their duty rate, I mean, that's a lot of extra work, a lot of extra shipping time, labor processing. You've increased the cost plus the duties. So, yeah, certainly this is not making trade more seamless, that's for sure.
Ryan, based on what you're seeing, is there anyone that thinks that the U.S. and China won't extend this deadline of their agreement, their truce, that's up tomorrow?
Yeah, I mean, I'm sure lots of people think they won't extend it, and some think they will. I haven't looked at what the prediction markets are saying on this. This administration is sort of inscrutable from my perspective. I don't really make a lot of predictions on that. So,
well, are people front loading and rushing before tomorrow from China, or no?
I mean, at this point, it's too late. So they were, people were moving stuff in, but no, I didn't see a lot of front loading on the China one. Yeah, fair enough. From the behavior of the actual actors in the market, it seems like they think it'll get extended.
Ryan, appreciate your time and your insights. Super valuable. As always, sir, thank you. Ryan Petersen there, the Flexport CEO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.